Over the past few weeks, an event has shaken the American financial system like nothing we have seen in years. Americans are finding it increasingly difficult to pay their debts. Total household debt has exceeded $18.3 trillion, and Trump's economic policies are only making matters worse. But the main story lies elsewhere. Two giant companies, trusted by investors, backed by major banks, and holding high credit ratings, collapsed almost overnight. These were not small firms. We are talking about billion-dollar corporations that on paper appeared completely healthy. One even had an AAA rating, a symbol of the safest investment in the world. Yet both companies fell so rapidly that Wall Street was left in shock. The first collapse was Tricolor Holdings, a company issuing auto loans to borrowers with poor credit histories. It earned money by granting risky car loans and then packaging them into bonds, so-called asset-backed securities. On paper, they looked flawless. Rating agencies even assigned them AAA, assuring there was no risk. Billions of dollars flowed through Tricolor because everyone trusted the rating. But in September, the unthinkable happened. The company missed just one interest payment, and nearly $2 billion in loans were suddenly at risk. Creditors panicked, repossessions began, and now the Department of Justice is investigating Tricolor for fraud. This is no longer just a business mistake, it could be much more serious. If the most reliable company can collapse this quickly, what does it say about the entire financial system? We are effectively witnessing the destruction of the American economy. The system is crumbling in large chunks, and trillions of dollars affecting everyone directly are vanishing due to Washington's irresponsibility and desperate corporate moves. America is drowning in debt, and cracks in the system are turning into chasms. The sudden collapse of Tricolor Holdings is not just the bankruptcy of a single company. It is a signal of how fragile the financial situation has become for millions of Americans. People are buried in loans and bills, and the White House is doing nothing to stop the bleeding. Tricolor owned 65 car dealerships across 6 states, primarily serving Hispanic families denied loans by banks. These were ordinary people who needed cars to get to work and buy groceries. Now the company is bankrupt, leaving billions in unpaid loans. Banks like JP Morgan and Fifth Third are losing hundreds of millions. Wall Street will survive, but the families who trusted Tricolor will lose their cars, money, and credit history. And this is not an isolated case. In 2024, over 1.7 million cars were repossessed, a record for the past decade. Today, 6.6% of borrowers with poor credit are more than 2 months behind on payments. Even people with good credit are starting to fall behind. Young people are suffering the most. Nearly 8% of Generation Z borrowers have missed auto loan payments, showing that staying afloat has become impossible. The reason is simple. The cost of living has spiraled out of control. Researchers say Americans can no longer afford even a minimal standard of living. The average car price has nearly reached $50,000. Loan rates exceed 9% for new cars and 14% for used cars. Insurance has increased 19% in just 1 year. What was once a symbol of freedom has turned into a debt trap, forcing families to choose between keeping a car or buying food and paying for housing. Instead of help, the Trump administration is only making the situation worse. His trade wars and tariffs are pushing car prices even higher. His deregulatory policies allowed companies like Tricolor to thrive. Now, as families lose their cars, the White House remains silent. There is no plan to ease the debt burden, stop repossessions, or curb rising insurance costs. Wall Street will take some hits, but will survive. Major banks will find loopholes, receive assistance, or pass the losses on to society. Ordinary Americans, however, will lose their cars, jobs, and financial future. And just when it seemed things couldn't get worse, another giant collapsed. First Brands Group. This major auto parts manufacturer had nearly $1 billion in cash, but filed for bankruptcy on September 29, 2025, leaving over $10 billion in debts hidden through invoice-based loans. Creditors are facing catastrophic losses. The collapse of First Brands is not just the fall of a single company, it is another warning. The collapse of these two giants is not merely a failure or management error. It exposes cracks within a much larger structure, the $1.5 trillion U.S. asset-backed lending market. built on financing secured by assets. This is the market where companies obtain funds by packaging loans, invoices, or other assets into securities and selling them to investors. Literally everything is turned into such instruments: auto loans, credit card debt, aircraft leases, and even music royalties. For years, this market was considered stable and reliable. Investors called it boring, predictable, and nearly risk-free. But now the question arises: how safe is it really? One investor told Financial Times that the collapse of Tricolor was one of the worst events ever seen in the asset-backed securities market. Consider this: a $1.5 trillion market, and this is already being called its worst crisis episode. Now look at First Brands. The company did not rely on ordinary bank loans but on hidden financing schemes tied to invoices. These debts were not directly reflected in financial statements, creating the illusion of stability. On paper, First Brands looked healthy, with nearly $1 billion in cash. But once the real numbers surfaced, the entire illusion collapsed. And this is not a problem limited to one company. If billions in debt can be hidden through invoice-based financing, there are surely dozens of other corporations using the same trick. How much debt is really hidden in the system is crucial. Asset-backed financing has become a key source of money for companies, investors, and consumers. But a single failure can trigger an entire chain reaction. Lenders tighten terms, investors sell securities at a loss, and companies lose access to financing. This process moves quickly, and it appears to have already begun. If this market starts to crumble, the consequences will go far beyond two bankruptcies. We are talking about the potential destabilization of a $1.5 trillion structure that supports a significant portion of the American economy. To understand how we got here, we need to look at who is issuing loans today. After the 2008 crisis, the largest banks scaled back risky lending. Regulators forced them to tighten standards, raise capital, and abandon the riskiest practices. For a time, it seemed the system had learned its lesson, but the demand for credit did not disappear. Companies still needed money, and investors craved returns. Into this vacuum stepped non-bank lenders and funds. Players like Apollo and KKR began filling the niche left by the banks. They built complex financial structures, allowing companies to borrow money while investors earned high profits. Deals became increasingly aggressive, with risks hidden in layers of financial engineering. Rating agencies generously stamped safe, investors chased returns, and everyone pretended the risks had vanished. But the risks did not disappear. They were simply pushed into a less visible corner of the system, where there was less oversight, less regulation, and more danger. The government also played a role in this story. Donald Trump, returning to the White House, promised to put America first. But for millions of American families, his policies meant higher expenses, growing debt burdens, and near impossibility of escaping the credit trap. The country is already drowning in record debts, and his actions only stoke the fire. It is no surprise that under such policies, Americans are finding it harder to pay their debts. But the real danger lies ahead. If trillion-dollar corporations can collapse literally overnight, what will happen when the entire $1.5 trillion credit market starts to crack? This is the question America faces today. Do you think the system can withstand this pressure? Or are we already witnessing the beginning of a new great financial collapse? Share your thoughts in the comments and be sure to subscribe to not miss the next analyses.